Good evening, everyone. On behalf of the Center for Policy Research, ICRIER, NCAER, IDF, it's an absolute pleasure to welcome you all to the 15th five-institution budget survey being hosted by CPR this year. For all of you who were here last year, you may remember the surprise announcement by ICRIER that it was for CPR to host. So we have fulfilled our responsibility upon being given that surprise, but in a bittersweet way, we'd have much rather that this was an occasion for all of us to get again on a Saturday morning for a long discussion and debate and a dialogue with everyone. But COVID has caused all sorts of good things to be put on hold, and therefore we had to reinvent the wheel and meet everybody on Zoom. So thanks to all of you for coming back on Zoom this time on a Monday evening. And a very, very warm welcome to Dr. Pinaki Chakraborty, who joins us this year as the Director of the National Institute of Public Finance Policy to our discussions and to the Five Institute Budget Seminar. Pinaki, a very warm welcome to you. And looking forward to many, many more such interactions with you in the future. The other break from tradition we've had to make as a consequence of Zoom is to try and discipline ourselves to speak for less time. Time will tell whether any of us succeed in doing that. But in order to ensure that we keep to Zoom rules and don't sort of exceed your patience and time limits, we also felt that we'd have to do away with the tradition of having an external moderator who sets the tone and brings all of us into a dialogue with one another as well as with all of you. So I'm going to play the dual role of both being a moderator as well as offering some of my remarks in the course of the conversation. So with that, and without much ado, a welcome to everybody once again. We'll try and keep this to somewhere between 90 minutes to about 2 hours. Please do put in your questions into the Q&A box, and my colleagues and I will try and summarize these questions as best as we can and pose them to colleagues. If there's a specific question you may want to ask to a specific panelist, do specify that so that we can make sure to direct it in the right direction. As we have always done, we'll go through all of the presentations before we open it up to discussion and debate. So with that, let me first invite Dr. Pinaki Chakraborty to offer his remarks on the macro-fiscal position.
Thank you, Yamini. I'll start with broad macro fiscal issues that I see in the budget as critically important. First, let me talk about the GDP growth, and this growth is the nominal growth of GDP assumed in the budget, and that is 14.4% of GDP. Total expenditure is around is 34, little more than 34 lakh crore, around 35 lakh crore, which makes it 17.71% of GDP, which is really above the normal trend of government expenditure, central government expenditure, which hovered around 12 to 13% of GDP if we look at data up to 17-18. And if we look at RE of 2021, these numbers work out to be something like 15 plus as a percentage of GDP. And then if we look at both revenue and expenditure side, there is a net revenue shortfall to the center. That means after the transfers to the states to the extent of 4,65,000 crore, and increase of expenditure to the extent of around 5 lakh crores. So this 9 lakh crores, if we take as a percentage of GDP, gives us this number, which of fiscal deficit, which is 9.5% of GDP. Now, for the RE 2021, in the year 21-22, that is the budget that we are talking about, the fiscal deficit is estimated at 6.8% of GDP with a revenue deficit number of 5.1. So fiscal
Pinaki,
deficit. Yes.
You don't have slides, right?
No, I don't have slides.
Oh, okay.
Yeah. So around 5% of GDP as revenue deficit and 6.8% of GDP as the capital, as a fiscal deficit. Now, there has been a lot of discussion about capital expenditure. I think it is important to recognize that Centre's capital expenditure in 1996 was 2.43% of GDP. And there was a significant change in policy based on the recommendation of the 15th Finance Commission in 2004-05. 15th Finance Commission recommended that Centre should not act as an intermediary between states and the market in terms of borrowing, and states started borrowing directly from the market. And in the year 2006-07, the Centre's the capital expenditure. So this reform was introduced in 2005-06, and Centre's capital expenditure, which used to be around 2.5% of GDP, dropped to 1.51%. And if we look at the data on capital expenditure from 2005-07 to 2017-18, it remained at around 1.5% of GDP. So this decline in capital expenditure is due to the change in policy, where Centre stopped lending to the states, which is to get booked in Centre's capital account as loans and advances. Now, in that context, if we look at the capital expenditure in the budget 21-22, it is estimated at 2.48% of GDP, which is almost a more than 1 percentage point jump as a percentage of GDP. So that's very significant. Second question with regard to the macro fiscal number is the revenue deficit versus fiscal deficit. Centre has large revenue deficit, which is at 5%, fiscal deficit at 6.8. So there is always these discussions about how do you manage this large revenue deficit. Now, if we break this revenue deficit, two major components are the CSS and the interest payment, and both are having the character of downward inflexibility. So in that context, containing revenue deficit would mean reduction in interest payment and reduction in expenditure under CSS. Now, having said that, if we look at the macro fiscal number going forward, Centre has given a glide path of fiscal deficit, and that glide path of fiscal deficit requires the fiscal deficit of the Centre to be to come down to 4.5% of GDP in 25-26. And if we look at the state's number as proposed by the Finance Commission, it should come down to 3 by 25-26, by 23-24, and then remain at 3. And together, if we look at the general government deficit and debt, it is the debt is supposed to debt should decline from 89% as estimated with the Finance Commission to around 85% of GDP. We are also talking about high growth. So in the macro fiscal context, if we look at, we are actually talking about high debt, high growth, high deficit number. And going forward, if we are growing at a very at a rate which is above 7% of per annum, in that case, the kind of fiscal space that Centre would have as a percentage of 4.5%, maybe we need to relook at the level of fiscal deficit that Centre should have at around in the midpoint of this correction path, because we are having a high debt which is at 89, which is supposed to be brought down to 85. But just look at one crisis, because the FRBM review committee was talking about bringing down debt to GDP ratio to 60%. Now we are talking about bringing down this debt to GDP ratio to 85%. So macroeconomic crisis can create serious fiscal imbalances and serious macroeconomic imbalances. So going forward, we have to be careful as far as the fiscal and macro management is concerned. I think I have completed my 10 minutes. I can come back later on if there are questions.
Thank you. Thank you so much, Pinaki. And you've really set the tone for being disciplined, not only in terms of managing our fiscal, the country's fiscal position, but also being disciplined in terms of managing our time. So let me now invite Dr. Shekhar Shah of the NCAER to offer his opening remarks.
Thank you, Yamini. Let me just share my screen. Pinaki was actually even better than 10 minutes, so that's fantastic. Can you see my screen, please?
Yes.
Okay. So what I thought I would do, first of all, thank you, Yamini, for doing this, and it's great to be here for the 15th such seminar. What I'd like to do is, the budget is already with us. We've discussed all the issues in great detail. They've been in the press. So I'm going to try and look at what we do next in terms of assuring a good recovery and a sustained growth path for our economy. And so here's a kind of catch-up sense of where we need to be if we are going to regain the kind of growth path that we had. And so we've got a number of simulations here. The first one, which is path one, is just a counterfactual, growing at 5% prior to the pandemic. Path two is highly optimistic. We catch up with our 2019-20 output level in just a year's time, in fact, this coming year, sustained thereafter by a 7% growth thereafter. Pessimistic is very low, 7% by 22-23. That's when you catch up with the 2019-20 GDP, and thereafter you grow at 4.5%. Then there's a business as usual, and then there's an RBI, Ministry of Finance kind of path. The key thing to look at here is that even with the highly optimistic path of a kind of big push surge in 21-22, and thereafter a sustained 7% real growth, you only catch up to your pre-pandemic GDP levels by 26-27. And indeed, on just the RBI's and the Ministry of Finance growth path, you actually don't catch up till 29-30. So this just sets the challenge that our economy is facing. And indeed, the emphasis on growth is going to be not only important, but really vital for us to achieve. And very quickly breaking that down, we didn't have a great place where we started. Since 2016-17, we've been slowing down well before the pandemic hit. And this wasn't a great place for us to obviously be starting. And you could see that in industry with the kind of sharp drop that we saw with the pandemic in the first quarter of this financial year. Then the sharp recovery, the kind of V-shaped recovery that people talk about. And thereafter, we are hoping, obviously, for the low base effect to take us out with a significant growth where we expect to be at about something like 7-8% contraction in GDP. Services, of course, have been hit even more, and there the pickup has been much less. You can see that the V is much flatter in this context. We tried to also look at what people have been calling the K-shaped recovery, where there's going to be a divergence between those who are able to protect their lives and livelihoods and those who are able to sustain opportunity for themselves. This includes large firms, corporates, those in white-collar jobs, where we haven't been able to, where we've not been affected by the pandemic, but others obviously have been. And you could see this in the right-hand chart, where there's a significant difference in the way in which the work that we do with firms, we do a business expectation survey every quarter, the sort of growth rebound for large firms significantly more optimistic than the kind of expectation of good things to come for smaller firms. So this is something that I think has been very much at the heart, and I'll come back to that in a minute or two. This is the big push on infrastructure, which is the kind of strategy that the government and the finance minister have chosen that we're going to push for expenditure, which is going to create public goods infrastructure. And the expenditure secretary and others have been very explicit that we had a choice. We had a choice between what they call capex or handouts, and we chose capex because we felt that if we did handouts, then there'd be precautionary savings and people may not spend from that money that they are given. And the multiplier for capex is, in any case, when it's implemented well, can be quite high. So this is going to be very much the leitmotif of this government's approach to the recovery. I want to break this down with some comments on a few of the things that have been at the heart. For example, the DFI, the new DFI institution that is expected to be set up. Very quickly, unless we have a serious corporate bond market, the experience with prior DFIs, whether it's IDFC or IFCL, have not been great. So that this DFI institution will work only if we work on the fundraising end of things and really give a boost to the corporate bond market. Similarly, with the bad bank, the idea that we are able to take the bad assets out of our commercial banks and put them and aggregate them and get a better price for them will again only work if there's a significant change in the way board members are appointed to these banks, where there's change in governance. There's a lot more to be done beyond just simply setting up institutions. So I think that's going to be extremely very important. But so what's good about some of this? I think the good parts are that there's a fundamental shift in thinking about what government should be doing. Because if you're going to spend all this money on infrastructure, creating public goods with good externalities, and if you do it well, and I'll come back to that in a second, and how are you financing it? You're going to finance it, at least that's what the intention is. You're going to privatize, you're going to give away and sell PSPs and PSUs, so that in a sense, this is really returning to a classic role of government. And if it happens, then clearly it's going to be an extremely positive thing and a positive direction for our country to have set. Therein, of course, also is the nub, which is that we haven't been terribly great at implementation. And so the entire burden of the strategy is going to fall on rapid, quick implementation, high quality infrastructure coming up. And that's not always been the case. The third thing that I wanted to mention very quickly was that the budget has, and Pinaki spoke a little bit about it, has been quite conservative in terms of the projections on revenue for 21-22. And indeed, even the RE for 2021 is likely to be exceeded. And this is a good thing. In general, fiscal conservatism is good. The bringing the FCI issues onto the budget is a very good thing. So the budget gets a lot of good marks on transparency. But the problem there might be that this dependence on infrastructure spending to both increase demand as well as release supply could be a risky strategy, simply because we haven't had a great experience of rapid implementation of these very complicated projects with land acquisition, with a whole range of other things that have to go into the process. And so it might have been better if we took a more realistic revenue projection, realize that we will actually have a reasonable revenue collection experience both this year as well as the coming year, and then use that headroom for a more sort of dual strategy of both infrastructure spending as well as spending for income support, dealing directly with people who have lost jobs, dealing with ways in which we could create demand amongst those sections of society that have the highest marginal propensity to consume. So I think that might have been a dual strategy, and perhaps it will be as we approach things in future in the next few months, that this may actually come on. I'll say a word more about agriculture. The issue in agriculture is really a kind of flat gross capital formation, where investments in agriculture have really been flat for the last 5 to 6 years. And indeed, this is going to be a major issue that we will need to address. And indeed, in that context, the budget doesn't do much. It only gives a very small marginal increase over this current year's RE on R&D expenditure and innovation in agriculture. So this is also an area that really does need a lot of attention. I'll stop here. Thank you.
Thank you. Thank you so much, Shekhar. Rajat, over to you.
Sorry. Thank you, Yamini, for the introduction. And the remark that I made last year about CPR hosting this year's budget seminar was prompted by the idea of a level playing field, which is going to be the focus of the last bit of my presentation. We've all done, at the end of this, I think we would have all done 3.
No free riders in this game.
So I'm trying to, is my screen visible?
It is visible, Rajat, but you might go to the slideshow mode so we can see a slide bigger.
Yes, I'm trying to do that. Is that good? Yes.
Yeah.
Thank you. Thank you, Yamini, once again. So in the interest of time, I will be sort of bullet pointish. There are 3 points that I wish to make emphatically. And they are here. One is on, of course, trade, which I will spend the most time over, trade, FDI, and global value chains. I want to spend a little bit of time talking about the good things and the not so good things in the budget. I'll talk a little bit about telecom and then round off with the idea of a level playing field when I talk about minimum government and maximum governance, an idea that has been promulgated by this government for the last 5 years. As far as trade is concerned, if one looks at India coming out of the pandemic, hopefully in this year and the next year, exports are looking good, primarily because of 2 reasons. One, global demand is likely to pick up, is already showing signs of picking up. And the focus that Shekhar was talking about on infrastructure hopefully will improve India's competitiveness. But I think that's the nub, really. How do we increase competitiveness of India's exports and make India a more competitive economy, just like we had done in 1991? And a lot of people were saying that this is actually a 1991 moment for India in terms of reaching out much more, engaging much more with the global economy by doing reform and liberalization, because, don't waste a crisis. 91 was a crisis. And 2020-21 is certainly a crisis. There's been a change in the Customs Act, and I think that will also add to improve trade facilitation, which is a continuous process rather than a one-time event. So I think on exports and when services begin to pick up, because there's a lot of pent-up demand in services, hopefully that India's exports will also pick up, and we'll see the light of the projections that government has been making about exports, about 500 billion and 1 trillion export economy that India is likely to become. No bets on when we will achieve that. We will certainly achieve that. But I think we really need to improve our competitiveness. And that's going to be sort of this budget, and the next few budget and economic policy will have a lot of work to do in trying to improve India's competitiveness and therefore export performance. The fact that we are in a situation, or we will end this year in a current account surplus, I think is a double-edged sword in the sense that a lot of people have been calling it an unwelcome surplus. And that's primarily sort of reflecting the economic slowdown. Imports have shrunk, exports have shrunk, but imports have shrunk even more. And therefore, we will run a current account surplus at the end of the year. That's okay. I mean, that's nothing to be unhappy about. But I think at the stage we are in our sort of point of development or stage of development, India might want to run a current account deficit, given that we can't run a current account surplus with every country that we have a free trade agreement with, and we can't run, every country can't run a current account surplus. Some countries will run a deficit and a surplus. But I think the fact that we keep talking about this both in an economic and much more in a political economy sense, that we must run current account surpluses, I think may be the wrong end of the wedge. We may want to run a current account deficit by importing the right kinds of things, capital that Shekhar spoke so much about, and also technology, so that we can become competitive over time. I don't think there's a harm in running a current account deficit, especially in case there is sustainability in the current account deficit. The other sort of area is foreign direct investment, and foreign direct investment has crucial links with trade and global value chains. The example of China, of course, stands out in front of us, how they leveraged foreign direct investment to begin participating in global value chains and then becoming the manufacturing export powerhouse that they have become. India's foreign direct investment performance hasn't been bad. In fact, in the last couple of years, we've been doing pretty well, but it's been below potential because India's potential is always very high. And we've attracted $70 billion, $50 billion worth of FDI, and we can do more. And this budget actually enhances the participation of the insurance sector. I'll come back at the end when I talk about government and governance, talk a little bit about this sector more. But, this is something that was waiting to happen. Of course, the crisis prompted this action to be taken so that we can get more investment, both domestic and foreign investment has a lot of spillovers. And India is anyway a sort of under-penetrated country as far as insurance is concerned. But foreign direct investment and investment in general has been limited in terms of sectors as well as in terms of geography. And I think there is scope to expanding both the sectors as well as the geography of investments for India. This is perhaps my most important slide, and I do want to spend a little bit of time talking about this, is the focus on Atmanirbhar Bharat. And I think a lot of attention, both in the budget and outside the budget, has been given on Atmanirbhar Bharat. And I want to emphasize and underscore the point that this Atmanirbhar Bharat is very different from self-sufficiency or self-reliance India of the 70s and 80s. Those of us who lived through the 70s and 80s recognize the walls of protectionism and manufacturing and firms being able to sell high-priced products, low quality, to a captive audience. This is nothing like that. But still, I think there is scope and there is place for policy changes as far as trying to become more participatory in global value chains is concerned, and as well as trying to enhance our engagement with the global market, both of which are mentioned in the budget and both of which remain commitments of this government. So the question is, how does Atmanirbhar Bharat, a liberal FDI policy, enhancing engagement in global markets, wanting to participate more in global value chains, how does that sit with the doses of increases in protectionism, especially across sectors that you want to domesticate, you want to bring those value chains India? How does this sit? Is it uneasy? Is this a conflict? Or is this a trade-off? Or are they incongruence with one another? And I would argue that if we want to look at the Chinese model of development, then I think this idea of a protected market, even if it is in sectors that we want to build competitive advantage in, I think this will benefit much more by a more liberal tariff policy rather than a more protectionist tariff policy. Remember, the idea of global value chains is that if you want to increase value added in your country, and I think that's the other important aspect this government wants to do, is increase domestic value added. Now, the more global value chain participation you have, the more goods cross borders, then value added content is going to be inversely proportional with the number of times trade in components or trade in content happens. So the more times a goods crosses barriers, the value added content in trade is going to decline. So if you want to participate in global value chains, you have to look at the idea of adding less value added content at home, importing more, and then over time trying to move up the value chains. Maybe that is the idea that we could pursue. So instead of so to say that in sort of simple terms, protectionism sits uneasy with our objective of increasing FDI limits, wanting to participate in global markets and wanting to participate in global value chains. And I think our commitment to engagement in the global economy is well placed because India needs globalization much more than any other country, because we are now on the path of growth. I'll spend just a couple of minutes more. One slide on telecom. And again, in terms of revenue collections from telecom, if you look at the spectrum auctions, especially last year, we reduced our projections from 1.33 lakh crores to 33,000 crores. And I think the revised estimates for this year are about 7.3 billion or 53,000 crores. And they sit on the back of an optimistic projection of the auctions. And those of you who are following telecom would recognize the financial health of the telecom sector, and the ability of operators to bid may not be that good at the moment. And therefore, I think there is room for government to reconsider the base price. So these projections have been made on a very high base price, and we could discuss that in the question and answer session, where if all the spectrum is sold at the base price, we would be fetching 4.5 lakh crores or thereabouts over a period of 20 years, and upfront we'd get about 50,000 crores, and that's the projection the government has made. I think it's quite optimistic, given that 700 megahertz spectrum, because of the high price, went unsold in the 2016 auction. Going unsold means government losing revenue. If you don't sell it, you lose it. And my final slide is on something that the late Finance Minister, Mr. Arun Jaitley, made an idea of minimum government and maximum government. And I think this is important, especially when we're talking about disinvestment of public sector enterprises that Shekhar spoke about. And just the last point, if you're going to have privatization and disinvestment of public sector, and there's going to be private sector participation in the same market, just like in insurance, just like in telecom, just like in banks, one has to ensure that an independent regulator is in place and that there's a level playing field. And this is something that the government must focus on when it's talking about minimum government and maximum government. Avoid regulatory proliferation, but at the same time ensure that regulation is unbiased, independent, accountable, as well as ensures a level playing field, both between public sector and private sector operators in the same market as it is in India. Thank you very much.
Thank you, Rajat, very much. Now, can I invite Nishant to offer his opening remarks on the social sector?
Sorry. Thanks, Shekhar. Thanks, Yamini. So what I was saying is that this is a very special budget for different reasons for different people. This is the third time I am doing this, so the social sector aspect of the budget on this forum. And I've always titled my presentation Human Capital. So it was quite kind of gratifying to see the finance minister finally use and recognize the fact that we are going to invest in people as one of the pillars. I mean, the follow through is a different question, something that we'll come to. But, so it was, at least there was a mention and a recognition of that fact. Okay, so what I'm going to try and do now is, over the last 3 sort of 18 months or so, we've really been presented with 4 budgets, because the 2021 revised estimates are essentially a COVID budget, a COVID affected budget in its own right. So what I'm going to try and do is understand from the budget numbers, what is it that the government is sort of, what expenditure is being prioritized. So what I have here in the 2 columns, and I'll come to why I have the first and the fourth, and the middle 2 are blank for now. But the first or the second column on the screen compares the 1920 actual spending to the 2021 budget estimates, which was that is the budget presented last February. And then the last column is the comparison of the budget estimates from last year, last February, to the budget estimates of this year. And there is still, obviously, there is a lot of hangover from COVID. So you'll see that the fertilizer budget, which they planned to cut, is now actually higher by about the same amount. Food is quite high, and so is rural development. The picture that I sort of want to focus on in this 10 minutes is this divergent paths which the government seems to take between education and health. So health, even in the last budget, there was an increase. There was a healthy growth in the health expenditure of about 6.5%. There's an even healthier projected increase of about 10.5%. Compared to the last February budget this year. Education, on the other hand, is a very different story. The plan last February was to increase the spend on education by about 11 percentage points. But what we plan to do now is cut down our expenditure on education by about 6 percentage points in nominal terms. So about 10%, real terms. And the path to this goes through the fact that COVID sort of affected the budgets a lot. And the second column here sort of shows that, right? So the 2021 revised estimate is really the COVID budget. And when you do that, you see this sort of a familiar picture where you have increased expenditure on food, increased expenditure on rural development, on agriculture. The surprising thing is fertilizer. I don't know the answer to why you would want to keep providing a higher production subsidy, but I'm willing to take any. I don't know the answer to that. But the interesting thing is the expenditure on IT and telecom, and commerce and industry, which is sort of the focus that both Rajat and also and Shekhar were talking about. And education, as I said, there is a decline in the education budgets in the move, but the health budgets are very healthy and are growing. That is the picture that I want to sort of focus on a little bit about, which is this distinction between health and education in the budgets. Before that, let me just quickly walk to the health budget, which was, so the aftermath of the budget presentation, there was this whole thing of whether there is a 137% increase or whether it's it's really window dressing. So this is the exact sort of annexure from the budget, and yes, there are budgetary provisions related to COVID and the Finance Commission grants, which obviously inflate the budget. But even if you do remove those, there is quite healthy 50% increase, which is really healthy, given the fact that what happened last year and the fact that the government's receipts are down. And I really do believe that drinking water and sanitation is a preventive health and public health necessity. Having access to hygienic conditions and hygienic drinking water is, in fact, one of the ways in which a lot of successful public health campaigns in countries that we like to admire now started. So I'm actually quite okay with bundling that with the health budget. The other sort of discussion point about the health budget is this vaccine allocation, and is it going to be enough or not, right? And so I'm just going to do a very simple calculation. The allocation is 35,000 crores, and the cost per person, let's assume it at 500 for 2 doses and 200 sort of ancillary charges costs. That gives us a reach of about 50 crore people. With the population estimates that for 2021, the adult population, because we don't yet have a vaccine for the young ones, is above 18 is 89 crores. And the vulnerable population above 60 is 26 crores. So 50 crores out of 89 crores is about 57%. And so that's a fair coverage. I think that's So to me, it seems that the problem with the vaccine coverage may lie elsewhere, but not really with the allocation. But I do believe that there may be challenges elsewhere. Now, education, the biggest loser is the Samagra Shiksha outlay, which loses about 7,700 crores. But there is a substantial increase in outlay to KVs, to Kendriya Vidyalayas and Navodaya Vidyalayas, right? So this is sort of in line with this idea of moving away from meeting the gaps in expenditure in existing schools and trying and establishing new institutions. I don't know if that is the right thing for the center to be doing, and I think I think one of the questions one needs to ask, and I'm happy to come back to this in the Q&A session, is really what the role of the center is in the education and health sectors, given the fact that states sort of pull the biggest weight in this, and these are state subjects. The higher education budget, I'm glad that I'm very happy to sort of note that has not been reduced, but there is a huge boost for world-class institutions, which I'm not sure is the best way to be spending our money. Finally, I'm going to end with 2 quick slides of how do we make sense of this? What is that we're looking at, and where should the education budgets and where should our human capital spending and expenditure investment be on? There was something that the finance minister mentioned with regard to health, and I think that is a policy I hope that she carries forward into the future budgets for education as well, which was that they're willing to spend more as the capacity of these institutions to absorb that funding increases. So that sounds like a plan, right? So I'm hoping there's one for education as well, because we need one. So this, the blue line on the screen is the growth in value added. It's a moving average just to smoothen the curve for value added over the last 40 years, or close to 40 years for us. This is employment growth. Okay. So the orange line that I have at the bottom, that is the employment growth. Now, the crucial figure, if you're thinking of not just COVID, but if you're thinking about a long-term growth path for India, the crucial figure right now for us is labor productivity. How much each worker produces, because that's how we're going to get growth, right? We need productive workers, and we need not only existing workers to become productive, we need to add productive workers to our workforce. But that's not happening, because if you look at the gray line, for the first 20 years, it tracked our GBA growth very well, because the labor force was the workforce growth was stagnant. But what has happened over the last 15 odd years is that there's been a decline in our employment growth. And so, yes, we've got labor productivity. In fact, we've got labor productivity, which is now higher than our GBA growth, because our employment growth base is shrinking. So we are getting productive, but with very limited pool of workers. And then I'm going to end with this slide where I'm just simply plotting the labor productivity in manufacturing and agriculture as a proportion of the labor productivity of services, the services being the most productive sector in the economy. Now, and this is something that should worry us. The good thing is happening, but it should still worry us. So our manufacturing productivity as a proportion of services was actually constant till 10 years ago. And it has sort of 10, 12 years ago, it has jumped up since then, which means that our manufacturing, and this is happening in other numbers also. So manufacturing in India is becoming more productive, but the employment in manufacturing is not growing. And our agricultural, which is not surprising, our agricultural sector is actually less productive than, and is becoming less productive compared to services over time. And so most of our workers actually are in this orange part, right? And we would typically try to move them to manufacturing. That would be the natural growth path that most countries follow, but we can't do that here. We can't move them to services because they don't have the skills. And I think that is where our worry lies, and I think that is where the plan that we need for our education and skilling and whatever we call it needs to address. So I'm going to stop here.
Thank you, Nishant. I now have the privilege of inviting myself to offer the closing remarks of the first round. My role in these discussions has traditionally been to bookend the discussion on the budget with a sort of political economy view to get a sense of the underlying political directions in which the policy choices that the budget reflects have been made. But to do that this year, I wanted to very quickly highlight a couple of things related to the macro fiscal position that I think have shaped the political economy of the policy choices that have been made from March 25th onwards, when the country went into lockdown, to where we are today. Sparsh, if you could move to the next slide. The big number that all, the following one, please. The big number that all analysts were looking at in the course of in the run-up to the budget was the fiscal deficit number, the 9.5% number that was top on everybody's minds. And the question for me was, what drove that fiscal deficit number? Our colleague Ratin Roy has consistently on this platform reminded us that that the central government is in the midst of a silent fiscal crisis. And therefore, given that the government was in a weak fiscal position to begin with, what did the crisis do to the macro fiscal position, and how did this shape the kind of policy choices? Two important things that I wanted to highlight here. Sparsh, if we can move to the next slide. While revenues fell, certainly, the real two drivers of the fiscal deficit was disinvestment receipts that fell from a whopping expectation of 2.1 lakh crores to 0.32 lakh crores. And for all the talk of disinvestment in the budget as a central source of revenue going forward, we do need to remember that for at least the last 2 to 3 years, if not longer, as revenue projections have always been lower than revenue receipts in the budgets, the expectation that receipts from disinvestment will help cushion has been long standing. And it is important to ask ourselves the question of whether disinvestment receipts should necessarily be funding committed expenditures or new expenditures. That structural challenge remains. In addition, the very, very important transparency that was brought into the budget that Shekhar and others have mentioned, which brought the off-budget expenditures back onto the budget books, particularly the loans from that the FCI, the Food Corporation of India, was taking for food subsidy, that were really leading to a lot of hidden expenditures and a lot of and hiding the true fiscal deficit. So these things combined, along of course with revenue expansion, created the context of this whopping 9.5%. And as we start looking forward to what happens in the following year, as fiscal deficit is due to come down to 6.8%, we do need to ask how this dynamic of tax revenues, the government has been relatively modest about its tax revenue expectations for next year, again placing a lot of hope on disinvestment, the governance challenges for disinvestment, realizing that disinvestment remains significant, and it is in that context that in fact the space that the government of India has to make expansive choices has actually been limited. And so please keep it back. I would argue that in fact the choices of sorry, could you just stick to the previous slide? I would argue that the fact that we had adopted a far less fiscal expansionary position at the start of the pandemic, and in my view continue to do so till now, has a lot to do with the fact that we were in a weak fiscal position to begin with, and this underlying structural constraint remains an issue. The second thing that I wanted to highlight is if we look at what happened to the budget in terms of expanded expenditure, even though the union government has historically been shrinking in terms of expenditure as a percentage of GDP, expenditure certainly rose this year to an expectedly highest ever since 1988. But it's important to look at what exactly was driving this expenditure in a pandemic year. The high subsidy bill, and there's been a lot of debate on how much of the FCI increase from about 1.1 to 4 lakh crores is driven by increased FCI, increased allocations versus bringing off budget expenditures back on book. A back of the envelope calculation done by Deepa Sinha seems to suggest that the additional expenditure was about 1.1 lakh crores, and the rest was bringing past expenditures back onto the dues. NREGA, of course, saw a significant expansions and the clearing of fertilizer arrears. So this collectively amounted to between 80% for the subsidies and about 12% of NREGA. Health expenditures actually didn't increase by all that much. As a total of the total increases, health expenditures increased by about 4%, which would suggest, and I'm going to come to this in a moment, that state budgets actually probably had a greater hit in terms of health expenditures. And the real story of what COVID did to the overall governments of India's budgets will come out once we have a clearer visibility on what state budgets for FY 2021 look like. The other important thing is expenditure contracted briefly. It started improving in October. CapEx expenditure saw an increase in November, but till December, the government of India had only spent 22.8 lakh crores. The current expenditure at the close of the year is expected to be 34.5 lakh crores. So there's going to be a lot of activity over these next 3 months. Some of it, of course, has to do with the FCI and the clearing of fertilizer arrears. But the larger point I want to make is that although there was a degree of fiscal expansion to respond to particularly to the need to provide a certain degree of support to the poorest who are equally impacted by the pandemic, our expansionary stance, even in the midst of the pandemic, was really not as expansionary as the numbers seem to suggest. Next slide, please. This leads me to the second really important point that I wanted to highlight about this budget. The next slide, Sparsh, if you could move on to. Yeah, no, the next slide. Apologies, the slide sharing issue on my computer gave trouble. One of the most crucial underlying political economy dynamics of this, both the pandemic response as well as this budget, relates to the dynamic of fiscal federalism. There is a very important stated commitment in the current budget on accepting the broad recommendation of the 15th Finance Commission for vertical devolution of 41%, but I think but many of the state-specific grants and sector-specific grants are still under consideration. But the real issue here is that even as finance commissions from the 14th and the 15th have been moving the intergovernmental fiscal dynamic in the direction of deeper devolution to states, in actual fact, the political economy of fiscal federalism has led to an increased centralization. The imposition of cesses and surcharges have meant that devolution has never really got to 42%. It's always ranged between 33 and 35. And this year, when state budgets, in fact, were extremely stretched and stressed as a consequence of higher expenditures due to COVID, devolution in FY21 was only 29%. The other really important thing to note is, where is this expenditure coming from? It's coming from centrally sponsored schemes and central sector schemes. In fact, despite an attempt to rationalize centrally sponsored schemes and central sector schemes within the 14th Finance Commission, we have in these last 5 years and continuing on actually witnessed an expansion in the centrally sponsored schemes and central sector schemes as a percentage of total expenditure. Central schemes from about 5% of total expenditure in 2016-17 to nearly 11% in current budgeted expenditures, and centrally sponsored schemes from about 2% to about 4% of total expenditure. Now, this is the real heart of the challenge, also of the macro fiscal constraints that Government of India is facing as well, that the dynamic of center state expenditures remain locked in a push to greater devolution and a demand for greater devolution from states, but also a political economy that commands centralization. A lot of the centrally sponsored schemes and central sector schemes are prime minister schemes. It allows for direct political attribution to the center. We've been seeing this in voting data, especially in the last election, direct attribution to Government of India through these schemes. There's a political economy reason why these schemes exist. But states too consistently demand centrally sponsored schemes and central sector schemes. So every attempt to rationalize these schemes always gets caught in this tug of war of centralization and decentralization. And this is going to be one of the most important sites of contestation as we move forward. The second 2 points, I know I'm running out of time, so I won't go down the slides. The second 2 points on the political economy I wanted to make was the following. The choice of capital expenditure and the big physical infrastructure push that is going to move the economy forward in FY20, in the remainder 2 months of this financial year and going forward in FY21. 21-22. It does seem like the government has determined for itself that India is now entering a post-pandemic phase, and the immediate set of the immediate crises around the pandemic is no longer a crisis for which fiscal space needs to be created to respond to. Nishant pointed out to a drop in expenditures. The most visible one in my mind is the planned reduction in Narega expenditures in the coming year. I think if you look at labor market data, particularly at the fact that employment rates are still not at pre-pandemic levels, if you look at the reality of the expansion of informality in the labor market as is visible through CMIE data, 49% of workers that were salaried workers back in April are now self-employed workers, and the K-shaped recovery that Shekhar was talking about, what seems very clear is that in fact the stress on the economy, particularly at the bottom of the pyramid, remains significant, and the absence of a support architecture is going to create a significant stress on the economy going forward. But it's important to also recognize that perhaps part of the reason why the government is comfortable with this, with the trajectory it's taking, is because it also has operated on an imagination of an economy where the modernization is on the back of formalization and digitization. And the K-shaped recovery, while the economy is certainly shrinking, is making the formal economy far more buoyant. Since GST and demonetization, there's been an approach to formalization literally with a butcher's knife without creating enabling conditions for the informal economy. And I think that thinking continues to persist at great cost, I might add, as we move forward into the second year of the pandemic, not a post-pandemic year. Last and not least, the tension between Atmanirbharta and versus the need for FDI and private investment, which remains at the heart of the political economy of the BJP. I think one important element of that also has to do with the increased concentration of capital. And Atmanirbharta allows for a negotiation on tariffs that in some senses will perhaps privilege certain aspects of capital at the cost of building a more robust manufacturing sector. That tension too remains at the heart of the political economy choices of this budget and of the economy going forward. So I'll stop there and now take it upon myself also to lead us into the next round of the discussions. Please do start posting your questions on the Q&A box, and we'll try and pick as many as we can as we go along. But let me begin, Pinaki, by asking you to come back in on two very crucial issues. You did mention the 15th Finance Commission, and you also spoke about the centrally sponsored schemes and that the revenue deficit is largely financing the centrally sponsored and central sector schemes. And as I see it, as I pointed out in my remarks too, it sort of brings to bear the central tension of that is at the heart of the fiscal federal challenge that India confronts. So could you talk to us a little bit about how you see the Finance Commission recommendations and how this is playing out into the choices in the budget?
Well, thank you, Yamini. On the question of Finance Commission transfer and centrally sponsored scheme, I wanted to highlight two issues. One is the recommendation of the 15th Finance Commission in the for the year 21-22. Now, for the year 21-22, if we look at the vertical devolution, of course, it is going to be 41% for the rest of the period of the 15th Finance Commission's recommendation. But there has been a significant increase in revenue deficit grant. So, revenue deficit grant, which is again untied transfer, increased from 74,000 crore to 1,17,000 crore. That's an increase of 64%. So, in other words, Finance Commission has factored in the issue of revenues uncertainty. So if the revenue is uncertain because of the pandemic, and if there is a revenue shortfall, the grant route becomes a route where it's more certain. It is going to go to the states because it is fixed in nominal terms. So that way, and if we look at the number of states receiving revenue deficit grant in the 21-22 includes various general category states, and total number of states receiving this grant is 17, which was never the case in earlier Finance Commission reports if you look at that 14, 13 and 12. So that way there is a preference that has been given that there should be some kind of revenue certainty as far as the revenue deficit, and many general category states have got it. That is one. Second, on the question of rationalization of CSS, I think it's a very difficult policy choice for the central government, because some of these schemes that actually take bulk of this allocation, which is roughly around 4 lakh crore, are in social sector, and then economic sector, then MGNREG, social sector plus MGNREG and PMGSY, and that constitute almost 90% of the total spending under CSS. So if we have to really reduce CSS as center's contribution, and that should lead to a reduction in revenue deficit of the center, we are essentially saying that you restructure CSS, reduce your contribution, and increase state's contribution. You have to keep that at that level. So in other words, the burden of revenue deficit is shift to the states. So there, I think the rationalization has to have two components going forward. One is the volume of CSS, how much center should intervene in state subject. That's the first point. Secondly, design of CSS. So if the design of CSS leads to better absorption, I believe that we can do it less money. But if the design of CSS is constrained by various things, which and that leads to an absorption problem, then probably we need more resources. So there is this issue of optimality of CSS, on which Central 15th Finance Commission has talked about, 14th had talked about it. So that is a larger policy question for which there is no straight answer. But if Center really has to withdraw from CSS, what is the alternative? That needs to be discussed. And finally, on the question of Finance Commission state-specific and performance incentive grants have not been accepted, but that fiscally is not going to be a major issue, because if you look at the total structure of Finance Commission transfer, 90% is tax devolution. And in this commission's case, if we take out the performance incentive grant, it remains at around that level. So most of the grants are growing as untied transfers and plus revenue deficit grant, which is again untied. But if we continue to restructure the design based on Finance Commission's recommendations, that's the kind of sense one gets from the ATR. Then we have to see whether it gets simplified or more complicated as far as the flow of CSS to the state is concerned.
Sure. Thanks, Pinaki. Shekhar, if I can bring you in, there's a question from the audience asking about what you see are the big risks to the growth projections. And your view, I think this is a commonly felt view amongst many of us, the disinvestment privatization approach. What is your sense on whether this will actually go forward? Certainly, given the liquidity in the markets, how buoyant the census is, this is an opportunity, certainly. But do you think that the governance challenges that have long confronted efforts at this investment can be overcome at such great speed?
That's a great question from Rahul Sharma. The impediments to rapid growth are going to be clearly a fickle investment sentiment, so that the notion that your public investment in infrastructure is going to crowd in private investment may not happen for a whole variety of reasons, including the inability to implement those infrastructure projects in a speedy way. So I think that is going to be a very important concern. The second is if there's substantial precautionary saving by households who have the highest marginal propensity to consume, but who, being at the bottom of the pyramid or being somewhere in the middle, are really remain concerned about their job opportunities, their income streams, and that leads them to continue to save in a precautionary way. So that's going to be an important part of the growth trajectory. The third is the monsoon. Only once in 20 years have we had 3 running good monsoons. We've had 2 already. So statistically, there's a bit of a problem in thinking about a third good monsoon. And that could really drive down growth very substantially, but also create a lot of additional pain in the economy, because farmers will be affected very badly by a poor monsoon. So those would be some of the obvious risks that, and of course the infrastructure push, given that we don't have this dual strategy, firing the gun on both barrels, kind of public investment in infrastructure and income support to people who clearly need that income support. And as I said, that's a clear choice the Ministry of Finance made: no handouts, public expenditure on infrastructure. So if we had that dual strategy, I think we would feel a little more secure about being able to reach 6, 7, 8, 9, 10% real growth. On the disinvestment, I think it's going to be absolutely critical to front load the disinvestment and the strategic sales, not only because global liquidity is plentiful and you need to do this before central banks start tightening up and become more cautious and start raising interest rates, but even taking just the internal view of the fiscal, it's vital that this money comes in. And the whole shift in thinking, which I talked about earlier, where the government intends to focus much more on public goods like infrastructure, finance that by letting go of the assets where it never should have been in manufacturing and services, then if these two things need to go hand in hand. And again, if that doesn't happen, that's a bit of a problem. What are the constraints in a good rapid disinvestment program? It's the 3 C's or the 4 C's. The problem with CVC, the CBI, and the CAG. They've been constraints in the past, and to that you can add the courts now. And it's the reluctance of very efficient, smart, intelligent officers in the government who are charged with making these decisions about what prices should things be sold at, that has constrained this in the past. The Kelkar Committee report on a kind of reimagined PPP model talks about these things. Now, we've moved away from PPP, so we've got over that hurdle. The government is going to invest in public infrastructure. It's going to manage the upstream risk, which it is the best able to manage, and then it will monetize the assets. And from the proceeds of that monetization, will fund more public infrastructure. So that's a well thought out strategy. But the disinvestment is really going to be critical, and it's going to be absolutely vital to front load this.
Thank you, Shekhar. If I may misuse my position as moderator, but put on my panelist hat and just add just a quick addition to what you're saying in terms of risks. I think the big risk that confronts us is there is likely now, we don't have enough data to be able to say this with any great authority, but one can speculate that there is going to be a slow movement of migration back from rural areas to urban areas. We do know, and Shekhar showed us some of that data, that we are certainly on the path to a profit-led K-shaped recovery. And one aspect of that profit-led recovery has been cost restructuring, as well as a shrink, particularly actually, and Pranjal Bhandari's work sort of highlights this, particularly among small listed companies. And we don't even know what's happening in the informal sector, but once again, we can speculate that there's been cost restructuring there. So jobs in urban areas are not going to come back as quickly as potentially people moving back into cities. And here again, what the crisis from March 25th onward highlighted for us is how vulnerable the urban poor are, or rather how vulnerable urban workers are, absent any kind of social protection architecture. So as people move back, as jobs are hard to find, the kind of distress pressures this is going to create on labor, and potentially disincentives for labor moving back from rural to urban areas, is something that we should take quite seriously. There was an attempt in the budget to talk about portability of one nation, one ration card, but again, that's nowhere near full implementation and not nearly enough. We really ought to have moved, frankly, towards a demand-based public distribution system. The one thing the pandemic taught us is that the PDS structure and NREGA actually work, can be scaled up and scaled down to needs. Those are two things where I think the argument from the Ministry of Finance is, if need be, we will do it. But we also know in the context of constrained revenues, the if need be really has to be very, very pressing, and the distress of the poor is always invisible. This was the opportunity, I think, to certainly push harder in the direction of a universal social protection architecture that addressed the challenges of the complete absence of any kind of safety net in urban areas, housing, as well as safety nets would have been crucial and important. And I think the absence of this in this budget, to me, is really jarring, especially against the backdrop of the migrant crisis. And I do think this is going to impact the economy going forward. Nishant, you wanted to come in, and then Rajat, there's lots of questions.
It's very hard to do these things given the complete lack of data on this. But I think one of the other problems is that I am not very confident about the upper part of the K either, because recessions are great for productive companies. If you are good, recessions are great because it forces you to do things that you would never have done, because now you can not have offices like Oyo. You can have chatbots instead of call centers. So I think that a lot of these,
the way we are talking.
Yeah, exactly, right. So you don't have, we are saving what, a few lakh rupees, which would have gone to creating some work for somebody. So I think that I'm not very confident of the upper K as well. And if the demand, sort of pent up demand that we saw clearing, is coming from savings and is going to go down, and we see the real lagged effects of employment in a quarter or I don't know, then I think we might really be in some trouble even in the upper part of the K. But again, I don't know any of this. I think it's pure speculation, because there is very little data to go by on this. But I do think it might be a challenge.
Well, CMI data that shows you salaried workers having. Yeah. What we do know is that the labor market is seeing an expanded informality, and that against the backdrop of sort of butcher's knife formalization of the economy and an absence of support to the MSME sector is, I think, a challenge. Shekhar, you wanted to come in, and then I have lots of questions for Rajat that we'll come to in a moment.
Actually, I had a question for Rajat, if I may. Rajat, how do you see Atmanirbhar Bharat sitting with Make in India? We may have even forgotten that in 2014 that was the swan song, and in some sense Make in India really said, make for the world in India. Self-reliance has all kinds of meanings, and I know that you're talking of strategic industrial policy when you think of Atmanirbhar, but should we not be talking about the world Nirbhar on India, so that, our goods, and that fits in with your competitiveness argument, but the two don't seem to sit well together.
Yamini, can I take that, or?
Sure, go ahead, and then I'll summarize a couple of questions and pose them to you.
So, I think that's the nub of most of the questions that are coming in. And I think, let me just pick up from where Yamini left off and where you asked your question, Shekhar. I think Atmanirbhar Bharat, as I emphasized in my comments today, is very different from the self-sufficient India that we lived through, at least Shekhar and we lived through. I think that self-sufficiency was self-destructive, I think. This Atmanirbhar Bharat is not as self-destructive, but I think we can use better policy instruments to get there. The central piece to my mind of Atmanirbhar Bharat or Make in India, and I think there's a lot of rhetoric around it, is the focus, what Yamini was talking about, to create more formal sector jobs with a butcher's knife or without, but to increase formalization in the Indian economy, because the bargaining power of informal workers has shrunk, especially after the pandemic, to an incredible low. And therefore, I think Yamini is absolutely right. And I think some work that ICRIER has been doing in this, and Radhika Kapoor from ICRIER has done some excellent work, and will continue to do some work on this, is to sort of reinforce what Yamini said, is that it's time to think about not universal basic income. I think Arvind pointed this out in one of his economic surveys, and I think got a lot of us thinking around that. And I think it was in the usual style that Arvind, he was throwing up ideas, trying to prompt a debate, and I think it served the purpose. We did begin to think about universal basic income. Of course, it can't be universal for India, given the huge inequalities that we've already talked about in this panel. But what Yamini mentioned, I mean, you have to try and extend social security architecture, including health benefits, to informal workers, because informality is here to stay. And with digitization and with platformization and with the economy becoming more gig, I think informalization, not by choice, but by circumstance, not by design, but where you are, is going to happen. And therefore, I think it is incumbent on the government, as this crisis has shown, given that the formal sector is not going to be able to absorb as many workers. We are trying to set up 7 textile parks, which have been talked about in this budget. We are trying to, get labor-intensive manufacturing started. We haven't crossed for the last decade 15% of GDP from manufacturing. So I think it's going to be a tall order. So while you get your house in order, while I get my ease of doing business in the top 50, I think it's important to have a path towards trying to bring in some social security architecture for the deprived, informal workers. And I think that is going to be absolutely essential. And the finance minister did talk about it in the budget, although there's not much, hopefully, over a period of time, there it will be. The second point I wish to make, and this sort of appeals to what I think Sanjeev has asked in the chat box and what Shekhar was asking, I think there is an apparent contradiction, but I think, industrial policy is designed to try and minimize those contradictions. So the way I see it is that, this increasing protectionism that we are seeing to encourage Make in India may be the wrong instrument to try and manufacture those components that we are looking to manufacture in India. Let's say PCBAs. If you increase the duty on PCBA, let's say the printed circuit board, does India have the ability to do that in a short period of time? Or whether the increase in duty will just make it more expensive and therefore affect our competitiveness over the medium term and the long term. So I think a better instrument to become competitive and thereby use strategic industrial policy to improve competitiveness, and these policies are on the table, I think. This is the production-linked incentives. And there's also the RODTEP policy, the remission of duties for exports. So production-linked incentives has been extended from 3 sectors to now 13. There are 10 more sectors that have been added, including electronics and autos. And then, of course, there is this RODTEP scheme. You will get remission of duties to the extent that you are exporting. And I think these are instruments that will serve competitiveness much better than to increase, protectionism. So I am not for a moment saying that we should not use strategic policy. As Sanjeev has pointed out, China did it for years, but China did it in their own interest. I think that's important to understand. They used, exchange rate policy, they used FDI, they used the domestic market to promote competitiveness and become the manufacturing, the factory of the world. By sort of increasing duty, one way to think of increasing duties in the auto sector is to, increase our leverage with, to the extent we ever get into a free trade agreement with the EU, we could then leverage our increased duties and say, okay, we will reduce the duties on auto components, something that the EU has been asking. But I don't think that's the strategic intent of this increase in tariffs or this protectionism. The whole world is becoming more protectionist, but not in a tariff sense. I think there are more non-tariff barriers, and one could argue till the cows come home whether the new protectionism, to borrow a phrase from Professor Bhagwati, is good or bad. But the whole point I'm arguing is from the perspective of India. Use instruments that make us competitive, that make us serve the world, and thereby increase jobs, while recognizing that our increase in jobs will be nowhere near the amount that we need, and therefore informalization will rule the day, and therefore social security protection is going to be important for the informal sector workers, especially urban informal sector workers. And just to reinforce the point that Yamini made, Yamini, just one more thing. Migration is going to happen. Migration happens for jobs. People are going to come back. This trying to set up rural India to stop migration or infrastructure in rural India, it will happen over time. Digitization will happen over time, but that could be a long time. And people will migrate to urban areas. We've seen that FDI flows into cities. We've seen that we have we are going to have 53 cities in India, which will be more than 1 million population strong. Very in the next decade or so. So, informalization, urbanization are going to happen. And I think this is a call that the government must take. So the design of your strategic industrial policy, just like we did in 1991, in our own interest, should be again in 2021 in our own interest. Not whether the rest of the world is doing it or not. It has to be in India's interest. And it doesn't serve India's interest to increase prices and make ourselves less competitive.
Thanks, Rajat. I think you also picked up a lot of the issues that were the core of many of the questions that were coming, which are really trying to get to the heart of this contradiction between Atmanirbharta on the one hand, FDI on the other. And, as I said in the sort of last moments of my remarks as well, this is also it's at the heart of this very interesting political contestation as well that sort of is shaping economic policy for the BJP. At one level, needing FDI is perhaps a necessary condition given the state of private investment on the domestic market, but the need to project the Atmanirbharta framing as core to what economic ideology of the BJP is now coming into an important intersection here. And there's also a very interesting tension between the sort of projection of India on the one hand is very much part and parcel of the global economy. We see Prime Minister Modi in his early days talked of red carpet, not red tape, the importance of ease of doing business, which comes up again and again as a political tool to signal openness, or again then giving mixed signals with the Atmanirbharta narrative. And I think what would be particularly interesting for colleagues to hear from you is, where is the increase in import tariffs? How does all of this sit together? Is there an industrial policy behind it that's driving it, or is there a lot of opacity and negotiation that's taking place?
I think there is some method in the madness. I mean, there is an intent, and there are certain sectors that we feel we are competitive in. And I think there is this electronic sector and automobiles. I think we have seen there is some sort of competitiveness in automobiles. And remember, the competitiveness in automobiles, both domestic and foreign, has been guided by foreign. I mean, Maruti Suzuki, for all intents and purposes, was foreign investment that came in, and Hyundai and Honda and Toyota. I mean, these are, investments, foreign direct investments that happened in India, and then created medium and small enterprises along the way, built up ancillary industries. So I think we have, of course, you can never get away from the fact of political capture by industrial houses. And Yamini, this is the point that you made. And I think I'm sure some of it is in play, and all of us have seen it play out in India, whether it was the Planning Commission or whether it is the Ministry of Commerce or Ministry of Finance. I think there is political economy, and it has been said that growth of industrial houses in India, to a large extent, could be sort of also, to an extent, be explained by their proximity to the political masters. And this has been a sort of a narrative that has existed for many, many years. But I think, coming back to your question, I think there is a method in the madness. There are certain sectors we aspire to be competitive in. My argument has been, if you really want to become competitive in those sectors, then I think the instruments have to be important. The instruments of choice have to be important. And, remember that argument in the 1990s about let's import computer chips and not potato chips, because we are going to fritter away our resources on potato chips, etc., with respect to foreign direct investment. Some of that also you see here today. If you look at the increase in duty structures over a period of time, you'll see that electronics has systematically seen an increase in duty. Now, mobile phone, end use has also been, or handsets have seen an increase in duty, so that we can manufacture those within India. And I think, we will be able to do that, except that we might lose some competitiveness. But some items that, see as useless or not being relevant to the development process. I mean, whoever decides this, furniture from China, for example, will attract more duty, because why should we import furniture? What value is it going to add? And I think that's another political economy sort of question, is that who gets a look into making of industrial policy? Who rides the route? So in a sense, is consumer welfare at all put at center stage when you're making industrial policy, or is it just producer interest that rides the day? And I think in India, we've often said it is producer interest, and you made that point, Yamini, that enables policy to be determined, because producers are more cohesive. Consumers, of course, are more diffused and are unable to organize themselves together. They don't have institutions to be able to lobby for tariff increases. They don't have, the power to create a Bombay club, for example. And therefore, I think somebody has to represent the interests of consumers. But, without going into that sort of Olsonian debate about who has more power to lobby for changes, I think there is some method in the madness, and we have aspirations to become competitive. I think the only thing that I would say that we have some right instruments and we have some wrong instruments in trying to be better.
Thanks, Rajat. Nishant, a question for you. 48% increase in health. Is it really over the 2021-22 period? I ask this because announcements are spread over a few years. And I think more broadly, there's been a set of questions around trying to understand how you see the both, particularly on the COVID vaccines, why you argue that what has been budgeted for is about right.
So as far as I can tell, yes, the 48% increase, the way I am counting 48% increase, though Santosh doesn't agree with me, but the way the 48% increase is actually for this year. And look, the question about vaccines, as I said earlier, I do not think the problem with vaccines will come from the allocation. The problem might come from the fact that, as was correctly somebody pointed out in the question, our coverage, even after years of effort for early age vaccination, is not good enough. It's I think, to the best of my recollection, about 60%. So how do we get to 70 to 80%? is which is what epidemiologists think will be required to break the chain of the spread. I don't know. And again, as I said, I don't think that these are the problems with that will be solved by spending money in this year or buying more vaccine. There are issues, especially in, I think, the more less denser, more rural parts of the country. There are serious issues with access to health. There are serious issues with quality as well. And the budget perhaps is not the right place to talk about, or for the government to talk about what can be done to increase that. I mean, there are other ways. There is this attempt to use data in a big way to qualify big, in a big way to access, track the spread of the distribution of the vaccine. Can it be useful? Yes. Technology can be extremely useful in building supply chains, as we see in the private sector. Can we do it in the course of the year? I don't know. I really don't know the answer to that. Yeah, sorry.
Thanks. Pinaki, question for, well, I guess both of us, but you can answer it and I'll chip in if needed. Why do we not see that continuing to persist with increasing revenue deficit financed to a large extent by borrowings is fast leading us into a debt trap, and the disinvestment hoopla is minuscule compared to revenue or capital expenditure? So your thoughts on the sort of, I mean, I think this is at the heart of the macro fiscal constraint that the union government has been confronting consistently now, and remains fundamental to what had, I think, led us to far more to depend far more on monetary levers than fiscal levers at the start of the pandemic, and continues to make us much more conservative about fiscal expansion, even if the numbers look larger than. Look good enough to make a political point. So over to you, Pinaki.
Thanks, Yamini. The question of revenue deficit versus fiscal deficit is a very complex one. If we say that tomorrow revenue deficit should be zero, that's just not possible. Even the Finance Commission's estimate shows that the revenue deficit of the center will be 2.8% in 25-26. 14th Finance Commission also had made estimates where there was revenue deficit in center's accounts. As I said, there is a problem of rigidity in revenue deficit account, primarily because of committed expenditure like interest payment, pension. Subsidy bill has significantly declined over the years because of the decline in petroleum subsidies as well as food subsidies as a percentage of GDP. Of course, this year there has been an increase because of NSSF things coming into the budget and showing an increase of 1.34%. But if we say tomorrow it has to be cut, this has to be shifted somewhere else, and that will be the states, because you have to then transfer the CSS completely to the states. Now it's a kind of a circle where if center wants to get out, then there has to be drastic cut in social and economic services expenditure that center makes through various centrally sponsored schemes. If we are not able to cut interest payment and pension, defense revenue expenditure as a percentage of GDP has not shown any increase. It is almost stagnant. In fact, recommendation in the 14th was that it should grow at the rate of GDP. Even there we see there has not been any increase. So if we have to really think of cutting expenditure in the revenue account, and if we don't talk about a significant increase in the taxes as a percentage of GDP, then we can only see center withdrawing for the CSS. That's the only space, but it's an extremely difficult choice that center has to make if it has to really do it. But it will shift somewhere else, and it will shift to the states, and we'll provide that money. We really do not know from the general government point of view. Now, if we look at the tax to GDP ratio, our tax to GDP ratio, Finance Commission report has done a tax gap analysis, which says that India has the potential to increase the tax to GDP ratio by 5 percentage points. So if we are talking about 15 and 16%, then we are at 21%. But that's not again going to happen. So revenue deficit is going to stay. On the question of disinvestment, yes, disinvestment targets are very optimistic for the last, if you look at budget of last couple of years, and we have not met the target. But my hope is, since we have the revenue projections are not very optimistic in terms of revenue, in terms of taxes. I think even if there is a shortfall in revenue deficit and the kind of expenditure that we see in the budget 21-22, we may not have a fiscal deficit of 9.5%. It may be much less. So where it will be, whether it is 6.8 or less or more, we really do not know. The last point that I wanted to make on the revenue deficit issue and capital expenditure of center, historically from 1980-81, if we look at data, if we take the central loan to the state, center's capital expenditure remained around 2% of GDP. And from 96-97 onwards, if we look at it, it's around 1.5 without the central loans to the state. So capital expenditure as a percentage of GDP hasn't declined. And when we talk about center's capital expenditure should increase, I think it's very important also to say in which all sectors. We don't want center's capital expenditure on subjects which are in the state list. So if we are talking about Pan India infrastructure, how it is financed today, whether centers should again have large public sector. And there is an inherent inconsistency when you see disinvestment, at the same time you say that you make more capital spending. So what is the macroeconomic framework we are talking about? So I think if we say that yes, center can have capital expenditure which is optimal at 1.5, center should spend on social sector. There are national priorities A, B, C, D, E, and this CSS will have to be done, and we accept that revenue deficit will be there. Now, if we say that revenue deficit is bad, center should not be there, then we should take a call whether center should intervene in subjects which center considers as a national priority as CSS. I think that debate needs to start instead of saying that revenue deficit is bad.
I think I completely agree with you, Pinaki. In fact, you got to the heart of the issue of the center-state contestation, which is really a question of going back to, probably even to first principles, what role of government should be performed at what level and how it should be financed. One other important point I just wanted to add here, we have seen a tendency now that has been noted by the Finance Commission as well, of the imposition of cesses and surcharges by the central government as a way of in the context of this push to deeper devolution, as a means also of at least protecting a certain amount of its own revenue that then goes on to finance the expansive centrally sponsored schemes. And just to give you a sense of the numbers, in 2017-18, cesses and surcharges minus the GST compensation as a percentage of gross tax revenue amounted to about 10.6, and this has gone up to about 15.3, actually about 18% in the current revised estimates, thanks in no small measure to the petroleum buoyancy in petroleum and diesel. So, the imposition of cesses has also has also added to this shifting dynamic of center-state financing and puts in new pressures on what genuine devolution means, even as now two successive finance commissions have been pushing in the direction of deeper devolution to states. Shekhar, if I may come to you now and also hand over the baton of further moderating to you. Rajat, I'll just come back to you in a second. I wanted you to focus a little bit on the question of the MSME sector. Many folks have asked us about both how we viewed the sort of monetary levers that were deployed to provide stimulus to the MSME sector, particularly the credit guarantee scheme, etc., at the start of the pandemic lockdown. And what do we see now in terms of the mobilizational ability of in the context of the overall policy choices that have been made? What do we see in terms of the future of the MSME sector? But sorry, Rajat, did you want to quickly come in on anything that we've just said before we move to the MSME?
I wanted to ask Pinaki this question, and anybody else, is this tax to GDP ratio, and this relates to sort of trying to increase the tax to GDP ratio for India. A center has never gone up beyond 11.2%. And I think what Finance Minister Jaitley had said is that we're going to try and reduce the administrative compliance cost of paying taxes. Vivad Se Vishwas was also talked about, and make it easier to pay taxes and have digitization and faceless assessments, etc. Now, we've seen an increase in the tax space. We used to lament in India that only 3 crore people pay taxes. Now, there's been an increase in the number of filers, Pinaki, and the numbers have gone up to, I think, more than 6 crores now. But tax realized hasn't gone up anywhere. In fact, has actually come down, of course, even if you account for the pandemic. So filers are increasing, but the tax to GDP ratio remains stagnant. Can one explain that? Despite the sort of trying to ease compliance burden of paying taxes, we haven't been able to expand this, people in the tax net productively, get them to pay their taxes.
Yeah, I think there is this, of course, first caveat. I think 2020, 21 and 21, 22 is, should not be considered as benchmark year for assessment of tax to GDP ratio. But yes, our tax to GDP ratio actually increased from 2002-3 to 2007-8. That's the era of high growth, high revenue, high taxes, low deficit, high tax to GDP ratio and low deficit. But if we look at from 2008-9 global financial crisis starts, and then we also see the changes in not changes. You see the tax to GDP ratio coming down, but one structural change has happened. If we look at the structure of tax revenue, the share of direct taxes post 91 reform has increased. It used to be around 17% of the total taxes collected in by the central government. Now it is around, I think it is around 50% of the total tax. So that way, if we say that direct taxes are more progressive than the indirect taxes, that shift has happened. But in terms of broadening the base, I think and lowering the rate, I think we have reached the threshold in income tax. I think reducing the peak rate below 30% is something which is not really desirable. In that context, I think technology, information, these things are going to play. As I think it also the major jump we see in 2005-6 is also because introduction of PAN, NSDL, technology coming in big way. But yes, one issue that we see that despite increasing the number of returns filed, taxes are not going up, also has to do with the overall slowdown in the economy. That part will have to be considered, and GST revenue hasn't been buoyant in 2017, 18, 19, 20. Now we see post-pandemic there has been a growth of in the last few months. So how it is going to play out, once the economy starts recovering, we have to see. But certainly, formalization has direct link with tax to GDP ratio. With large informal sector, you also have this problem of low tax to GDP ratio. So base is still very narrow, and they are broadening the base and lowering the rate, both, and particularly in case of GST, going forward would be probably helpful.
Thank you. Thank you.
I think that has a lot to do also with the push towards formalization, which is a push that is, I think, not adequately thinking about how to create enabling conditions to move the informal sector into the formal, rather assuming that forced formalization will expand the base. And we saw with GST what a significant challenge that created. Shekhar, to you on the MSME, and I think that'll probably be the last sort of remarks before we wrap up.
Okay, actually, I just will share my screen quickly if I can and just show you the kind of change that has happened. So there's been a large budget increase, as we know, in the support to MSMEs. I think it's about something like 180% increase in the budget allocations in 21-22. The problem is that most of it is for credit. And I'll just show you some data that we've collected as part of our business expectations survey, which shows that in the last 3 months, only a third of MSMEs took a loan. So here's this column, took loan during the last 3 months. You see these smaller firms, just very little. And if you look at some of the things that they find challenging, just the lengthy paperwork involved for these small firms, more than half, almost 75% of these firms saying that really credit is a problem because the process is too cumbersome. So the difficulty here is that if they had suggested direct, or if they had put in direct wage support as other countries have done, I think it would have been a lot more sensible than just providing credit. And this has, of course, been the kind of story that we've seen through 2020, where credit guarantees and other things were provided, but not direct support. I suspect that maybe down the line, if we don't see vibrancy in the informal sector that Rajat talked about in the small and MSME sector, there's going to have to be direct support of some sort or the other. So I very much think that while the headlines are all there, the difficulty is that we don't have this process in a way in which I think it's really needed, especially at this stage. I think Nishant wants to come in on this.
Shekhar, I actually have a question for you. Sorry, I had a question for Shekhar. So how much of this stress is or fault lines exposed by COVID rather than the stress that is healthy firms being stressed because of COVID, or unhealthy firms being exposed because of COVID? Because I think that, see, one is that, I understand what this, that, unlike other countries, and especially given the informality that everybody's talking about, direct wage support for firms that are trying to hide labor bills is a bit difficult. They won't take the direct wage support for the same reason they don't register. A lot of them don't register, right? Because it just exposes them to bureaucratic processes they don't want. So I'm just wondering how much of it is sort of the churn that is going to happen at the upper end or is happening, and how much of that is there. If the survey, that survey that you were mentioning, is there any indication of that, or?
I think this is a pressing problem. It's a critical problem. TV Somnathan, I think, has said that, look, I would have loved to have given income support, but I just don't know how to identify the workers and do it in a systematic way. So that's partly the problem.
I have to say, on this one, every challenge that the government confronts is significant. Even dealing with the NPA challenge and what's happening in the financial sector is not an easy one. There are always answers. It's the choices we make. I agree, it's not easy. It's not impossible. We've already got many databases we can use. We chose not to use them. And in the peak of a pandemic, a choice could have been made to allow a degree of leakage, which we are making, by the way, in CapEx, because not like CapEx is free of leakage for income support. Sorry, I couldn't help but pop in there. But if I may, I'm terribly, terribly sorry. But I had another commitment. So I do need to move on. But I'm handing the baton over to Shekhar to close, and I'll be here to as we close as well. So over to you,
Yamini. Thank you for organizing this as well. So I was just going to actually make the same point that had we started with income support in a more significant way, besides just what we did in agriculture, for example, we would have learned a lot about how we might be able to target better. And in a sense, we gave up that opportunity during a lot of 2020 when we said, the credit guarantees are available, so take a loan. But
I think, in fact, one might argue that actually for direct income support, there is less moral hazard compared to credit, because you can identify firms that want to exist and or function against firms that don't. I mean, just off the cuff of it, I don't know, but I think it might be a good separating equilibrium to employ direct wage support to identify firms which are willing to formalize and register themselves and take the support.
Yeah, no, it would certainly have helped a lot. There are still a number of questions, but perhaps what we should do is just go around, and since we're almost close to 8 and it's going to be close to 2 hours soon, maybe we could just go around and sort of check in with each of us whether we have something more to add and what we might see in the coming months. The budget is done, but surely the task is not. And there's going to be a lot of information coming through, a lot of data coming through, and the work that all of us do in our think tanks that's going to inform the policy decisions that are around. Yamini, you're still here. Are you logged into another meeting, or are you able? Do you want to say something at the end?
Well, no, just to firstly to thank everybody. Really appreciate all of you being here, and thank you, ICRIER, for passing the baton on to CPR. It's been a privilege to organize the discussion. My great worry, as I've said consistently through, is what happens to the informal sector and the deepening informality in the labor market, which is going to have a direct repercussion on demand. And I think for the moment, at any rate, we seem to be veering in the policy direction of a crisis that is past and a future that looks rosy. My own sense is the crisis is still very much there, and the future may not well be as rosy as we think. And so thanks with that.
Okay, thank you, Yamini. Pinaki, any parting words?
Yeah, thank you. I have just one point to make, and that is on reprioritization of government expenditure. I think we need to look at reprioritization that is happening within government expenditure, within social sector health. I think that's very important. And as you mentioned, that more data coming in, and we need to look at, I think here it is very important to look at the combined government expenditure, that is expenditure including state expenditure. So central expenditure plus state expenditure, if we look at 60% of the combined government expenditure is spent by the states. Health is a state subject. A lot of livelihood security measures are taken by states, and predominantly it's state-sponsored programs. So I think once state budget comes in, we'll have a better understanding of what has happened since last April. So that means 2021 RE at the combined level, also BE of states for 21-22. So that work, I think, as think tank, it's very important to undertake and see how states have managed this crisis, how center has managed this crisis, and what is the aggregate picture. We still don't have the aggregate picture. We are talking about the central budget and an intent of spending for the year 21-22 and some inferences from the RE. I think it will be more important to look at the aggregate picture going forward. Maybe by July or September, August, we'll have a better understanding when all the state budgets are presented.
Pinaki, in a word, do you think the pandemic is going to be a shot in the arm for taking state finances much more seriously than sometimes the center does? Or is it going to go the other way?
No, I don't think centers take state finances lightly, because 65% of the divisible pool of resources goes to the states. So there is this structure of center-state relation, which is fiscally decentralized structure.
No, so for example, the ceiling was raised in many views, from the point of view of many people, much too late. That it could have been raised earlier, for example, for state deficit financing and things like that.
Yeah, in terms of, I think for the states going forward, we have to ensure that there is adequate fiscal space for redistributive spending. That's the primary responsibility of the state government. Center does not have much redistributive expenditure, and that is where that space will have to be provided. For this year, the fiscal deficit number is 4 for the states, and going forward it will be 3.5 and then 3. So there is an asymmetry because centers one is 4.5. That is why in my initial remark I was saying we need to revisit this when growth picks up, when we are out of this pandemic. So what will be the aggregate fiscal imbalance picture, taking both center and states together?
Okay. Rajat, parting words?
Thanks, Shekhar. There's been a lot of talk on Atmanirbhar Bharat, so I'm going to stay away from making any further remarks on Atmanirbhar Bharat. But I do want to make a point on something that I reflected or said towards the end is as the government transitions out of production, and it's made a call, it's taken that call to transit out of production, whether it's services or manufacturing, and to involve itself in producing of goods and services. As it does that, and as it makes a transition to minimum government or reduces the size of public sector in the economy, I think simultaneously there's going to be a drastic need for the government, an incumbent need for the government to think about governance, because as the transition towards a market-based economy becomes much more sort of prevalent and pervasive, how is that governance going to be done? And I think that's a challenge that confronts the government. I don't think there's adequate thought, just like I think Pinaki was saying about a macro fiscal framework. I think around even strategic trade and industrial policy, a thought process around that has been sort of absent for most times. And I think we don't want to be caught napping as the government exits its role as a producer and a service provider. And I think eventually it will. We need to think of how to regulate some of these sectors much better than we have been doing. And the issues that you mentioned, and Yamini mentioned, Shekhar, about challenges of actually getting the process of disinvestment going. The governance will not only involve getting that process right, but post that process is done, if it happens, getting the institutional and governance process absolutely right, so that we don't get further political capture by big business.
So I take it that what you would also then say is that this budget and the direction that it sets for government investment and government involvement in the economy is going to actually require much more sophisticated state capacity and government capacity, and that the government better start thinking about how it's going to acquire that capacity and sustain it.
Absolutely.
Yeah. Nishant?
Yeah. So see, as far as the, I just want to make two quick points. So one is that, this question of inequality and income support to the lower end of the distribution. I think that we have a structural problem there. COVID has, yes, it's magnified the problem 100-fold, but we do have a structural problem because I think we have been through social security schemes, the biggest one being NREGA, we have been supporting the same people over and over again. So it's not as if we are, so this is, dynamic poverty. We are not talking about probabilistic changes in your income and then you falling back upon bad times. So I do think that we have huge, quite apart from what we have seen from COVID, I think we have huge structural challenges coming up in terms, specifically in terms of the capital labor composition and technology, changing that in the future. So, and as a society, we really need to worry about embodying some of that human capital the finance minister talked about in our young people. How do we do that, given that education is a state subject, and what role the center should play? And the huge disparities, I mean, in terms of education and health and the social sector, there's huge disparities amongst Indian states in terms of provision, how much they spend, what is the quality of that expenditure. And so what role the center can play, rather than spending directly on building one school in each district, which really doesn't help anybody except the people who are studying there. I think that needs a discussion, and I think that needs the same discussion that we've had about, for example, GST. We need urgently to have a national education policy bill made by the center doesn't actually do anything, right? Because it's kind of where we want to go, which has no commitments by anyone, because the states don't have to follow it or follow it at their own pace. They can interpret it in the way they want. So that would be my thing. I think that going forward, we really need to worry about this as a country, and not, how do we do it together? So that would be my.
You said you had two things. Is this?
So I said one thing is, one is that if continued support for social security, I think the only way out of it is to actually head on take on some of these structural challenges, because otherwise we will not be. We can talk about expanding our social security to urban areas. We won't have the fiscal space to do that unless we have a high growth path, which I seriously believe is going to be hampered by our people if we don't change something now. So that would be over the long term what I mean, this year is special, but over the long term, I think this is something we need to tackle head on.
Okay, thanks, Nishant. With that, let's bring this 15th Five Institute Budget Seminar to a close. I want to thank first and foremost the over 300 attendees that we had joining us. This is a fantastic showing of interest in this area. And I really thank everybody for being with us now for 2 hours. I'd like to thank Yamini for organizing this and for holding us together. And of course, Rajat, Nishant, and Pinaki being the newest member of this group. We look forward to your sustaining us for the future. I'm sure that there's going to be a 16th budget seminar that will be even more interesting as we look back on a tumultuous year 2020 and a year full of promises and risks 2021. But with that, let me bid everybody a good night, stay safe, and we look forward to better times for all of us and for our country. Thank you all, and